Stop scrolling because what I'm about to show you will completely change how you look at every car finance deal you've ever seen advertised. There are 7 specific finance structures being sold to British drivers right now that sound extraordinary on paper. Low monthly payments, 0% interest, flexible terms, brilliant deals, and are quietly, systematically, mathematically emptying bank accounts across Britain. And I mean emptying, not nudging, not slightly expensive. Genuinely destroying people financially in ways they don't discover until it's too late to do anything about it. The person who designed these deals is not in the showroom with you. They're in an actuarial team somewhere with spreadsheets, and their job is to structure financial products that feel like advantages to buyers while functioning as profit extraction mechanisms. Every word in those deals has been tested. Stay with me. Let's crack on. The 0% finance trap. 0% finance, no interest. Manufacturer paying the interest on your behalf. Sounds like the perfect deal. And it is for the manufacturer. A consumer finance economist in Oxford who has studied automotive finance structures across European markets explained what 0% actually means in practice. Manufacturers don't absorb interest costs out of generosity. When they offer 0% finance, they recover the cost of that interest subsidy through the purchase price. A vehicle offered at 0% interest will have a list price 2 to 4% higher than the same vehicle without the 0% offer. The interest cost hasn't disappeared. It's been capitalized into the price you paid. The mechanism is sophisticated because it's invisible. You compare the 0% deal to a conventional finance deal. Lower monthly payment, no interest, obvious winner, but you're not comparing it to buying the same car with independently arranged finance at market rates from a lower base price. That comparison never gets made because dealers don't present it. We analysed 62 0% finance offers across 12 manufacturers in the UK market over 18 months, The Economist said. In 57 of 62 cases, a buyer who arranged their own finance at commercial rates and negotiated the purchase price independently would have paid less over the total term than the buyer taking the 0% deal. The 0% was more expensive in the majority of cases. There's a second trap embedded in 0% deals that almost nobody discusses. These deals typically have no early repayment flexibility. The fixed payment schedule is the only schedule. If your circumstances change and you want to clear the finance early, you may face penalties or find that early settlement isn't structured to your advantage, because the dealer has already sold the 0% agreement to a finance company at a premium that assumes full-term repayment. A third-party financial advisor in Exeter who reviews car finance for clients identified a pattern. Every 0% deal I've reviewed has a clause that restores interest charges if the buyer misses a single payment. One missed payment, illness, banking error, direct debit issue, and the entire remaining balance immediately attracts interest at the standard rate, which is typically between 7 and 12%. The 0% was conditional from the start. Buyers don't understand that. Before accepting 0%, get an independent quote for the same vehicle with conventional finance and a negotiated cash price. Do the total cost calculation over the full term. In most cases, the 0% deal loses. The extended term monthly payment minimizer. This finance structure is the one most actively pushed by dealerships right now, and it's the one that generates the highest total cost for buyers while presenting as the most affordable option. Walk into any dealership in Britain and ask how they can make a £30,000 car fit a £300 a month budget. The answer involves extending the finance term from the standard 48 months to 60, 72, or even 84 months. 7 years of payments on a new car. A debt counsellor in Newcastle who specialises in vehicle finance arrears described what she sees in her caseload. The majority of clients coming to me with vehicle finance problems are in extended term agreements they didn't fully understand when they signed. They focused on the monthly payment. £300 a month is manageable. They didn't calculate that 84 months of £300 is £25,200 in payments alone, before you add the deposit and the balloon payment, on a car that's now worth £8,000. The mathematics of extended term finance are genuinely shocking when laid out completely. Take a £28,000 car, standard 48-month PCP at 7% APR with a reasonable balloon payment produces a monthly payment of around £480. Extend to 84 months and the monthly drops to around £290, seemingly much more affordable. But the total amount repaid over 84 months exceeds the total repaid over 48 months, despite the lower monthly figure. And the balloon payment at month 84 is based on a vehicle that's now 7 years old and worth a fraction of what it was. The extended term minimizes the monthly number while maximizing the total extraction, a financial journalist in Edinburgh who covers automotive finance explained. Dealers receive the same commission regardless of term length. Often they receive higher commission on longer-term agreements because the finance company captures more interest income. There's no incentive in the dealer's model to put you in a shorter, cheaper deal. The hidden cost that makes extended terms catastrophic: depreciation. A 3-year-old car with 18 months of finance remaining has positive equity. It's worth more than the settlement figure. A 7-year-old car with 12 months of finance remaining is almost certainly in negative equity, worth less than the settlement. Extended terms exponentially increase the probability of sustained negative equity throughout the agreement. Never extend a term beyond 48 months. If the monthly payment doesn't work at 48 months, the car doesn't fit your budget, regardless of what any dealer tells you. The Guaranteed Future Value Manipulation, PCP, Personal Contract Purchase, is Britain's dominant car finance product. Its central mechanism is the guaranteed future value, the manufacturer's promise of what your car will be worth at agreement end, which determines your balloon payment and your monthly cost. This number, the GFV, is not calculated to benefit you. It is calculated by actuarial teams to serve manufacturer interests. And understanding how it's set reveals why PCP deals consistently disadvantage buyers. A former automotive finance product manager who worked for a major manufacturer's captive finance arm in the UK spent 8 years setting GFV figures across model ranges. She described the process. GFV setting is a risk management exercise for the manufacturer. We set GFVs to minimize our exposure. If we set the GFV too high and residual values fall, we end up with cars returned that are worth less than we guaranteed. We take the loss. So we systematically set GFVs below our own residual value forecasts. We built in a margin of safety that protected us. The margin of protection built into GFVs is typically 8 to 15% below the manufacturer's internal residual value forecast. This margin has two effects. First, it increases the monthly payment, because a lower GFV means more of the car's depreciation falls within the payment term rather than into the balloon. Second, it systematically creates situations where actual end-of-term values exceed the GFV, meaning buyers who hand back cars are leaving value on the table. In a normal residual value environment, a buyer handing back a car at agreement end is typically handing back a car worth £2,000 to £4,000 more than the GFV, the former manager explained. That surplus value evaporates. It goes to the finance company when they auction the returned vehicle. The buyer who drove the car for 3 years and maintained it, whose choices created that positive variance, captures none of it. This is the calculation I referenced at the start of the video. When you hand your PCP car back, there is almost certainly positive equity that you never see. The GFV underestimated the car's value. The car sold for more than the GFV. The surplus is the finance company's income. The alternative to handing back, at the end of any PCP agreement, get an independent market valuation before making any decision. If the car is worth materially more than the GFV, sell it privately or through a car buying service. Clear the balloon with the proceeds. The surplus is yours. Buyers who do this consistently capture £3,000 to £5,000 that handing back buyers surrender. The mileage penalty architecture. Every PCP and many PCH agreements include mileage limits. These limits are presented as reasonable allowances calibrated to typical usage. They are actually precision-engineered revenue generation mechanisms that generate hundreds of millions in excess mileage charges annually from buyers who were set up to exceed their limits from the start. A consumer advocate in Cardiff who has reviewed hundreds of PCP agreements described the pattern she consistently finds. Dealers systematically underestimate annual mileage during the agreement setup process. A buyer who describes driving 20,000 miles annually will be quoted on 15,000. The lower mileage produces a lower monthly payment, which closes the deal. The excess mileage charge at agreement end, typically 6 to 10 pence per mile over limit, is never discussed in terms of its total financial impact. The financial impact at 10 pence per mile, 5,000 miles over annual limit, over 3 years, £1,500 in excess mileage charges due at the end of the agreement, on top of any other end-of-term costs, charges that arrive as a single invoice when the buyer is simultaneously managing the transition to a new vehicle. The timing is deliberate, the advocate explained. End-of-term charges arrive at maximum psychological vulnerability. The buyer is excited about a new car, managing multiple financial decisions simultaneously, and receives an invoice that feels like it must be wrong. Most pay it without challenge. But there's a deeper manipulation. Excess mileage charges are calculated at agreement end, at a rate set in the original agreement. Buyers have no ability to renegotiate. Buyers who recognize mid-agreement that they're exceeding their allowance and contact the finance company to adjust upward are offered additional miles at rates significantly above the original per-mile charge, because the finance company knows they have no leverage. An automotive finance solicitor in Bristol described a case. Client had been offered excess miles at agreement signing for 6 pence per mile. Mid-agreement, having established she was exceeding her limit, she contacted the finance company to purchase additional miles. Rate quoted 12 pence per mile. Same finance company, same agreement, same client. Rate doubled because they knew she needed the miles and had nowhere else to go. Before signing, calculate your realistic mileage honestly, add 20%, and negotiate from that figure. The monthly payment difference between 15 and 20,000 annual miles is small. The end-of-term difference is potentially enormous. Stop. Think about what we've established. 0% deals that cost more than conventional finance. Extended terms that minimize monthly payments while maximizing total extraction. GFVs set to systematically capture your car's surplus end-of-term value. Mileage architectures engineered to generate end-of-term charges. 3 more finance structures to cover, and these are the ones industry insiders describe as the most financially dangerous because they operate at the moment of maximum buyer vulnerability. Before I continue, comment right now. Tell me what finance deal you're currently in, or the worst finance experience you've had. Every comment helps someone else recognize what's happening to them. 3 more. Number 1 has destroyed more household finances than any other single car finance product in Britain. The add-on insurance cascade. You've negotiated your car, you've agreed your finance, you're in the finance office, or increasingly on a digital handover page. And now comes a series of insurance and protection products. Gap insurance, payment protection, tire and alloy insurance, paint and fabric protection, key insurance, lease protection. Each is presented individually, each sounds reasonable. Together they represent the single highest margin element of many car purchases, and they're deliberately sequenced to exploit the psychological state of a buyer who has already committed to the transaction. A former dealership business manager in Southampton who handled finance product sales for 9 years described the psychology underlying the presentation sequence. By the time a buyer reaches the finance office, they've made the big decision. The car is chosen, the finance is agreed, the emotional investment is total. At that point, the threshold for additional spending drops dramatically. We'd quote gap insurance at £25 a month, which sounds trivial against a £400 monthly payment. What we'd never say is that £25 a month over 48 months is £1,200 for a product available for £200 from an independent provider. The insurance cascade works through comparison anchoring. Everything is compared to the monthly payment, never to its standalone cost. Tire and alloy insurance at £8 a month sounds minimal. Over 48 months, that's £384 for coverage that pays out an average of once per agreement for most buyers, for repairs that typically cost less than the total premium paid. Paint and fabric protection was our highest margin product, the former manager said. Retail price £700 to £900. Actual product cost, the chemical application, £12 to £15. Margin of approximately 98%. We'd tell buyers it was an essential protection for maintaining their finance agreement's fair wear and tear standards. It was fabricated urgency for a near-zero cost product. The regulatory position on these products changed significantly following FCA investigation into motor finance add-on insurance in 2021. But the products remain, the margins remain, and the sequencing psychology remains, because it works. Independent gap insurance from a direct provider costs £160 to £220 for equivalent coverage to dealer-sold products at 6 to 12 times that price. Buy it independently. Decline everything offered in the finance office. Research and purchase protection products separately after completion. The part exchange negative equity roll-up. This finance structure is the one that creates the most severe and most sustained financial damage to buyers, because it compounds across multiple successive finance agreements, creating a spiral of increasing negative equity that traps drivers in finance agreements they can never escape at reasonable cost. A debt resolution specialist in Liverpool who works with clients in financial difficulty described the mechanism. Client comes in with a car they're unhappy with. 3 years into a PCP, car isn't worth the settlement figure. Classic negative equity situation, common at this point in a PCP. Dealer offers to help them into a new car. The settlement figure and the car's trade value are assessed. The negative equity, the gap, is quietly rolled into the new finance agreement. Client drives away in a new car, feeling like their problem's been solved. They're actually deeper in debt than when they arrived. The rolled-up negative equity is the structural vulnerability that makes this deal so dangerous. It's added to the new purchase price, increasing the amount financed, increasing the monthly payment, and almost certainly creating a higher negative equity position at the equivalent point in the new agreement, because you're now financing a car plus previous negative equity. I had a client who'd done this 3 times across 12 years, the specialist said. Each time she was unhappy with her current car, often for legitimate reasons, she was offered a solution that involved rolling negative equity forward. By the time she reached me, she was financing a car worth £14,000 with an outstanding balance of £23,000, £9,000 of negative equity. She had no idea how it had accumulated. She thought she'd been getting deals. The arithmetic is merciless. Roll £4,000 of negative equity into a new £20,000 agreement and you're financing £24,000. At 7% over 48 months, your monthly payment reflects £24,000, not £20,000. The extra £4,000 in the loan costs you more than £4,000 over the term because you're paying interest on it. And the new car begins depreciating immediately. So, by month 18 of the new agreement, you have the original rolled negative equity plus new depreciation exceeding equity, creating a structural negative equity position that's larger than when you started. Never roll negative equity. If you're in a finance agreement where settlement exceeds car value, the only rational choices are to continue the agreement to positive equity or accept the loss explicitly at the point of exit. Rolling it forward transforms a manageable single loss into a compounding financial spiral. The salary sacrifice electric vehicle scheme, Britain's most sophisticated finance trap. We've reached the deal that has generated more financial damage to more households in Britain over the past 3 years than any other single finance structure, and it's one that's actively promoted by employers, endorsed by government guidance, and presented as a straightforward tax efficiency. Salary sacrifice electric vehicle schemes, offered by employers as a benefit, structured as a 3-way arrangement between employer, employee, and lease company, marketed as driving a brand new electric vehicle for significantly less than a conventional lease, because payments come from pre-tax salary, saving income tax, and national insurance. The tax efficiency is real. The financial traps within the structure are also real, and they're almost never explained at point of entry. A senior employment tax advisor in London who reviews salary sacrifice schemes for corporate clients described what the marketing omits. The fundamental misunderstanding most employees have is about what happens if their employment ends during the scheme. The vehicle is leased by the employer, not the employee. If you leave employment voluntarily, redundantly, through illness, the employer's liability for the lease doesn't automatically transfer to you on favourable terms. You may face immediate full settlement of the remaining lease. You may face early termination charges. The vehicle disappears or becomes extremely expensive. None of this is mentioned in the promotional materials. The early termination liability is the specific trap that has caused the most damage. A 3-year salary sacrifice scheme for an electric vehicle with monthly lease cost of £600 has an outstanding liability at month 12 of approximately £14,400, the remaining 24 months of lease payments. If the employee leaves employment at month 12, that liability doesn't simply end. The lease company requires settlement. The employer may or may not indemnify the employee depending on the specific scheme terms, and scheme terms vary enormously. I reviewed 47 salary sacrifice scheme agreements over the past 18 months, the advisor said. In 31 of the 47, the employee indemnity position for early termination was either ambiguous or explicitly adverse to the employee. In 16 cases, the employee would bear full early termination liability if they left voluntarily. Most employees had not read the scheme terms. They'd read the promotional summary. A financial planner in Cambridge who advises clients on employee benefits described a case that illustrates the real-world impact. Client entered a salary sacrifice EV scheme at 38 months. Month 22, redundancy. Outstanding lease liability was £9,600. His employer's scheme had an ambiguous indemnity clause that the employer interpreted as not covering voluntary redundancy acceptance. Client ended up with a £9,000 invoice on top of redundancy stress.